Okay, let's do this next handout. Exercises, solutions to the exercises. A few of these we've actually gone over already, but that's okay. It'll just be a review. And speaking of which, we have one right here, the very first question. If you've watched all of the videos, you'll see this question twice, but not everybody watches all the videos, so I'm trying to get it to you at least once. It says the classification and normal account balance of the dividends account is what? Well, choice A is wrong on every front. It is not an expense, and it does not have a credit balance. Well, if that's true up here, then B is automatically wrong. At least the expense part, it does have a debit balance. Dividends are not a liability, and they do not have a credit balance. So so A, B, and C are all wrong. Let's look at D. It says stockholders' equity with a debit balance, and this is absolutely the truth. If we think of, now I want you to understand, and I've said this before, dividends, the dividends account does not have to show up on the balance sheet. In fact, it really shouldn't. In our textbook, I believe in our examples it might, but that's because this is an introductory level course. Dividends are actually a subtraction so if we take I'm messing this all up here. Bear with me. I'm going to change this here too. If we take earnings and we subtract out dividends, that's going to equal retained earnings. So dividends, or what we've paid out in cash dividends, are embedded in retained earnings. They lower retained earnings. So it is a part of the stockholders' equity section. And so if we think about it, we would have to assign dividends a debit balance, because when we pay cash dividends, cash, which is an asset, is going down and assets are reduced with a credit. So the only other way to do it is to make dividends have a debit balance. Therefore, D is the correct answer. All right, next question says the process of transferring the debits and credits from the journal entries to the accounts is called A, sliding. This is an error type answer. B, transposing is also a type of error. C, journalizing. Well, we've already done that when we made the journal entry. It's called journalizing. But when we transfer the debits and credits from the journal entries to their actual account so that they can appear, so that the correct balance for that account after all transactions is on the trial balance, we call that posting. So D is the correct answer. All right, another review question. We've had this question, I believe this exact question before. It says the payment for monthly rent will require which of the following entries? Debit to cash and debit to rent expense. Well, cash is going down, so we can't debit it. Credit to cash and a credit to rent expense. Well, this part's right, but if rent expense is going up and rent expense has a normal debit balance, we can't credit it. If we credit rent expense would be going down, and that usually does not happen. C, debit rent expense and credit cash. This is actually going to be our correct answer. So let's say we had a rent payment of $800 a month. We would have rent expense, and then we would have cash. I think I said $800. There you go. And we've also had this question, but I really want you to get this through your head. The unearned revenues account is an example of a liability. This is absolutely a true statement. And the reason is because the revenues are unearned. Remember, this is the accrual basis of accounting. So revenues that are earned are not an asset. They're strictly an income statement item. But when we receive cash for something that we haven't done yet, cash goes up, but so too does the liability to do whatever it is we were supposed to do. Maybe we're mowing lawns and somebody pays us $50 to mow their grass before they get back from vacation. Well, they've given us the money up front, but we haven't mowed the lawn. So we would technically have a liability to them until we mowed that lawn. Once we mow the lawn, there's no more liability. So unearned revenues are not an asset. They're not an income statement account. They are a balance sheet account, specifically a liability. All right, next question. It says, what is the best explanation for this journal entry? On March the 6th, we have cash received of $2,500 and unearned fees for the same $2,500. So this is an example of a journal entry that we have that would pertain to this previous true-false question. Okay. Received cash for services performed. Well, if the services have been performed and we received the cash, then the fees would be earned, not unearned. So that's an incorrect answer. B, received cash for services to be performed in the future. So we have an obligation to perform these in the future, yet we've already received the cash. That makes this cash unearned because we have not performed the services yet. B is going to be the correct answer. All right. Looks like we have another example here. It says, which is the best explanation for this journal entry? Now, I don't believe that we have discussed note payables, but we have discussed the concept of payables. So it looks like what we have here, see, we have one debit, equipment, and we have two credits. So let's see here. Purchased equipment, paid cash of $5,000 with the remainder to be paid in the future. And this is the correct answer right here, because we paid cash of $5,000. So the $5,000 cash, which is reduced with a credit of $5,000. So that part's true. And then we have a liability or an obligation to pay this this remaining $10,000 here. So choice A is going to be our best journal entry explanation. I don't actually ask you to do that many journal entry explanations. Okay, I don't ask the on-ground class to do them. But we need to be able to, if we're being asked to make a journal entry, we need to be able to explain what it is we've done, and we need to be able to recognize what somebody else has done. Okay? If you can't pick out the answer here, if you can't pick out these correct answers, then guess what that means? It means that something has taken place and you don't know what it is that has taken place. So we need to be able to identify what has taken place, or if I tell you what has taken place, you need to be able to show how that would be journalized. Okay. One more question and we can wrap this one up. Says, which of the following entries records the receipt of cash from clients on account? Now, we've had a question similar to this. I don't know that we've had this exact question. So let's see. Maybe we have, maybe we haven't. I do not believe that we have. All right. So it says accounts payable debit, fees earned credit. Well, at this point, we're just mixing up stuff. This is a terrible answer. Accounts payable are for whenever we buy something on credit, and then fees earned are whenever we're selling something on credit. So this combination is completely unrelated. So A is not only a wrong answer, it's a really wrong answer. Let's see here. B, accounts receivable debit, fees earned credit. This is also incorrect. This is the initial journal entry that would have been made. Okay. B, this is a legitimate journal entry. This is what would have happened before we collected the cash. Okay. So B is wrong. C, accounts receivable debit, cash credit. This is completely backwards as to what the correct answer is. And then let's look at D. Cash debit, accounts receivable credit. Okay, so initially what we had here was we had accounts receivable, and using their language, we had fees earned. We'll just say that it's $500. Okay, so this is the original journal entry. And if you think about it, it matches choice B, which is a wrong answer. Let me go ahead and circle the right answer so we don't get confused. Okay, so this is initially. This is what happens first. But second, which is what the question actually asked for, is we receive the cash, and then we have to credit. So we got the cash. In this case, we're using the example $500. And then by crediting the account receivable, it goes away. So the client no longer owes us that $500 because they paid us, and we have the cash of $500. Okay, we'll wrap this one up now.